Hey guys, it's Jack. As more and more popular cryptocurrency exchanges are handing out your details to the taxman, it's become ever more important to get your taxes right on crypto and ultimately avoid paying some as well. Obviously, we're not going to be doing something complex and dodgy. Yeah, maybe next time, Dave.
You were caught doing what?
See, I have to be very careful of how I title and how I present this video. We're going to be covering tax avoidance, not tax evasion. Allow Jimmy Carr to explain the difference.
So this isn't tax evasion, this is tax avoidance. So it's following the letter of the law, not the spirit of the law, and leaving it up to us to decide how much we pay.
Also, I'm not a tax or financial advisor, so please seek help where you need it from a suitably qualified professional. The government has different views on cryptocurrency, as maybe you and me have, and that affects the way they are taxed, which I'll get to in a second. For a start, they don't believe cryptocurrency is an actual currency, like pounds and pence. They actually call it a crypto asset, and they tax it in a similar way as a property or stocks and shares in a company. But the really good thing about this is that instead of learning all of these tax terms, you only need to be worried about one, and that is capital gains tax, or CGT for short. There are in fact only 4 ways where you need to be worried about giving taxes for your cryptocurrency. The first way in which you'll be liable to pay taxes is when you sell your cryptocurrency for real currency like dollars and pounds. I know all currency is fake. Don't hate on me, guys. The second way in which you'll be liable to pay capital gains is when you swap or exchange your cryptocurrency for another cryptocurrency. So swapping a Bitcoin for Ethereum, for example. And it's not just first swap, it's every single time you do a swap. And now the third way, a lot of people get caught out on, and it's an easy mistake to make. But before I tell you that, please make sure to like and subscribe if you're finding this video useful in any way. So the third scenario is spending your crypto, exchanging it for goods or services. Remember, capital gains tax will apply because the government does not see cryptocurrency as a real currency. So watch out if you're planning to buy a Tesla, if of course Elon brings that back. Cheers Elon for temporarily messing up the crypto market. I ain't buying any of your Teslas, mate.
Throw me a freaking bone here.
And now the fourth way is if you give your cryptocurrency to someone else apart from your spouse. I'll get to that in a second. Now, what exactly is capital gains tax? Well, it's a tax that applies on the gain, the profit you make from buying a cryptocurrency at a certain price and selling it at a higher price. It's not a tax on the value, it's a tax on the profit you made. Essentially, in the UK, the amount of tax you would need to pay will depend on your tax rate. There's only 2 tax rates to really worry about here. Either you'll be paying the 10% tax rate if your annual income is under 50k, or you'll be paying the 20% tax rate if your annual income is over 50k. So really easy to think about. You also get a handy £12,300 tax-free allowance. An example would be that, let's say you made £30,000 from your Dogecoin investment, because I'm sure everybody's made a lot of money on that. £12,300 from that will be put to the side as being tax-free, so you don't need to be worried about paying taxes on that amount. The rest of the money, £17,700, would be called a taxable gain and will be liable for taxes. And then, as I discussed earlier, the amount of taxes you'll be paying will depend on your tax rate. If you fall into the 10% tax rate, you'll be paying £1,770 to HMRC. Or if you fall under the 20% tax rate, you'll be paying double, so £3,540 to HMRC. Now, one way to get around these taxes is by carefully using your tax-free allowance of £12,300 with a popular technique amongst the tax dodgers called bed and breakfasting. If you made a huge amount of money and you know the tax-free allowance of £12,300 a year isn't going to cut it, you can take advantage of the fact that you get this tax-free allowance every single financial year. So what you could do is sell £12,000 worth of that crypto, get the cash, wait, and when the new tax year kicks in, you can just buy the crypto again, thus redeeming your tax-free allowance. This will give you a new buying cost in the eyes of the government, and the previous year's gains will be basically washed away, forgotten about. Now, this will work great if you're planning to hodl. You can keep doing this every single year and taking advantage of this tax-free allowance. Now, I didn't make this technique up. This technique was used with stocks and shares for a very long time until the government went a little mad and introduced some requirements. You have to comply to these requirements to take advantage of this. The requirement is that you have to wait at least 30 days before you repurchase your cryptocurrency again. Therefore, you can't sell a day before the tax year is over and then buy it back in the morning when you're in the new tax year. That's why it was called bed and breakfasting. Now, if you did this with a more stable, quiet stock, the likelihood is that in 30 days it wouldn't be much of an effect to the share price. Your sell price and your buy price wouldn't see much impact in 30 days. However, cryptocurrency is an extremely volatile asset. A lot can change in 30 days. Elon Musk can start tweeting again on the day you're planning to buy back the crypto again. If you sell your crypto and in those 30 days the price has become parabolic, you've lost out on those potential gains because you're out of the market. So there are certain risks you have to consider. This isn't the same with the next method. In fact, the next method really depends on how much you trust your spouse. In the UK, if you transfer your crypto to your spouse, it won't be seen as a gain or loss. The point of this is that you both get a tax-free allowance. Instead of having £12,300 on your own, you can get £24,600 tax-free allowance. This can wipe out any tax you need to pay if you're under this amount. Now, you really have to trust that they won't go out and spend it, and of course you probably do trust your partner because you are married to them. And if you're not married, you sort of have to weigh in whether it's worth getting married for a £12,300 tax advantage. But then again, you have to hope that they won't pull a Melinda and take away 50% anyway. Yeah, let's just hope that doesn't happen. The next method doesn't need any other party, just yourself and your stupid mistakes that you've made in the past. To reduce your taxes on crypto, you can write off any losses you've made in the last 4 years. For these losses to be counted, they don't actually have to be crypto losses. They can be from stocks or any type of asset class. To work this out, let's just use an example. Let's say you made a terrible investment and invested in Hertz or Wirecard and lost £10,000. As bad as this is, you can use this £10,000 to your advantage when reducing your tax for HMRC. Let's say you made £30,000 off a cryptocurrency. You have your £12,300 tax allowance. Considering the loss of 10k within 4 years, your taxable gain would only be £7,700 instead of £17,700 because that's your profit from your investing and trading activities. Also, it doesn't have to be one single transaction. If you've made a whole skew of losses, you can put them back up and use them to your advantage. As well as offsetting previous losses, you can also offset what's called allowable cost. This can be the transaction fee you've paid before the transaction is added to the blockchain, or the advertising fee for you buying or selling the crypto if you're not buying it off an exchange and you're buying it privately. You can write this all off and reduce your capital gains tax. Before I get to how you should actually go about reporting your crypto gains to HMRC, it's worth knowing a few tips. There's one tip you need that you kind of won't realize until you're actually stuck in it, and that is to reduce the amount of transactions you make for buying and selling crypto. If you're essentially trying to time the market and sort of trading crypto, you have to work out every single capital gains tax on each single transaction. Now, this can get quite complicated unless you're using a piece of software which can track everything properly, which is why I'm already buy and hold type of guy. Anyways, you can report your taxes to HMRC in 2 ways: by either completing a self-assessment form at the end of the year or using the capital gains tax real-time service to report it straight away. All of this can be done on the government portal online. Please like and subscribe if you found any of this information useful, and I'll see you in the next video. Thank you so much for watching.